Listen to This Week in Money, Saturdays on Internet Radio at TalkDigitalNetwork.com. This week's scheduled guests from Chartworks, Ross Clark. From the Gloom, Boom, and Doom Report, Mark Faber. From WolfStreet.com, Wolf Richter. Plus, we'll have a company showcase update from American Manganese CEO and President Larry Ray. Don't miss This Week in Money this Saturday on Internet Radio at TalkDigitalNetwork.com.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Drew Zimmerman. He's a portfolio manager at PI Financial in Vancouver. His website's pifinancial.com and polarfuturesgroup.com. Welcome back to the show, Drew.
Thanks for having me on again, Jim.
We had Trump pull the U.S. out of the so-called Iranian deal. World leaders are upset about it, but of course we know Mr. Trump marches to his own drummer. What's this going to do to oil prices in the long run, do you think?
Well, near term, we've definitely had a lot of volatility. We had a $3 range in crude alone just yesterday. So definitely some volatility when we were getting different leaks or different headlines before the announcement. And then when it came out that he was going to pull the U.S. Out of the deal, then oil prices started to move higher. Now, we didn't make new highs right away, which kind of gave me the feeling that we may have been setting out for a buy the rumor, sell the news sort of price action. However, overnight and into today, we did see oil prices break above $71 and make new 3-year highs. So there is two very kind of clear ways that I try and look at it. One is basic supply and demand, how much oil is being produced every day in different countries versus how much is being used on a daily basis in a global capacity. And in that sense, we do have, the reserves or stockpiles of crude moving lower when you look at 5-year averages and that sort of thing. And that's largely been in part due to OPEC cutting the supply or capping their output. And, the gift that keeps on giving for OPEC has been sort of the implosion of Venezuelan production, and that has been, involuntary OPEC production cuts out of Venezuela and something they still continue to struggle with. Some more news this week about ConocoPhillips going in and trying to seize some oil assets, that sort of thing. But again, so supply going lower through the OPEC side of things. However, you've got new prices or higher prices really pushing the supply side in the United States. We just got inventory data this morning that showed the U.S. production up to 10.7 million barrels a day. So we've got the world's largest oil producer, Russia, producing at around 11 to 11.2 on the high side million barrels a day. So really the U.S., and this last week alone, was over 80,000 barrels, 84,000 barrels, I think, increased per day. If we're going to continue at the recent pace that we've been going at in the U.S., we could see the U.S. be the world's largest oil producer sometime later this year. And that would have a dramatic shift in the power of the energy market and especially the amount that the United States exports. So that's on the supply side. The other factor that, of course, this Iranian deal really has is the geopolitical side. Has this move by Trump, worked to destabilize the region some more? So we know that Israel has accused Iran of continuing to build nuclear weapons. Saudi has accused Iran of proxy wars, both through Syrian forces as well as the Houthi rebels in Yemen. So will this further sort of escalate those issues? And the way I try and look at that is, in the last 3 months, we've had a $13 rally in crude oil. We've gone from $58 to $71. That's over 22% in 3 months. It's been a pretty significant increase in the price of oil. And you try and look at that in the context of the supply-demand issues and geopolitical issues. So, I think you could probably break it up close to 50-50 at this point, maybe even more on the geopolitical side. So, have we priced in what we need to price in on the geopolitical side, or geopolitical risk side? And if that's the case, over the near term, are we then extended? Especially if we see the U.S. supply side of oil continue to increase. So my thought is oil is likely getting ahead of itself. Again, a 22% increase in 3 months, while being sort of pushed with this momentum of geopolitical risk and supply constraints, may have priced it to perfection. That being said, when prices are going like this, you do see that last sort of parabolic move happen. So we could possibly see more headline-driven gains rather quickly, which make it very hard to trade. You got to be very careful to the upside with crude oil, that's for sure. But I'm looking at it as being overextended near term. So I'm willing to maybe stick my toe in the water on that front, but definitely not getting aggressive, because, again, you can see rather rapid price appreciation in a very short time.
We'll have more with Drew Zimmerman right after the break.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
Welcome back. We're speaking with Drew Zimmerman. With rising oil prices, do you see big benefits to the U.S. or the Canadian economies, or both?
Yes, you do. If you look at the U.S. To start with, Texas has now become the national leader on annualized Q4 GDP. They were up to 5.2%. That was after the last few years of declines, where they did have some quarters up, some quarters down, but again, some very serious growth coming back into the Permian Basin, especially. That really is, driving jobs, driving manufacturing, driving wage pressures. That is, and especially given the size of the GDP in Texas, really helping the economy as a whole in the United States. And we are seeing some of that benefit in Canada as well. Again, our heavier crude, especially in northern Alberta, not seeing the same sort of bounce back that we've seen out of some of the shale plays. And again, we're having some infrastructure issues that is maybe holding Canada back a little bit as well. That's pipelines and rail not being able to transport our product as well as others. But at the same time, we're running into those issues down in the United States as well, or they're running into bottlenecks of their own, whether that's the water and sand for fracking as well as pipeline capacity to move the oil. So when you have, the amount of change in product volume that you've seen in the United States, that can be expected, that you just, can't ramp up the infrastructure fast enough. But I think they are working to alleviate those issues, so that, the economy can continue to grow. And again, when you kind of have to build quickly, you tend to see prices go higher. So, the economy's moving faster, moving forward. Where in Canada, it seems to be a little bit more of a, political bottleneck than, say, one of actual, physical capacity for pipelines. The money is there, the money can get spent. We're just not seeing the ability to have that follow through to then help the Canadian economy in a way that it possibly could be.
With the Kinder Morgan deadline of pulling out of the project to build a pipeline between Edmonton and Burnaby, the deadline is the end of the month. Have you heard anything from the backroom discussions going on between Ottawa, Alberta, and Kinder Morgan?
I hear just as much as everybody else, and it seems like every day or every second day there's a headline or two coming out about it, and it really is one of those things where you just have to say, I believe it could go either way. We've kind of had the federal Liberals stake their reputation on it to some degree that it's going to get pushed ahead, but again, you really do have to come back down to Kinder Morgan's side and say, is this going to be worth it? And, if we get something done now, does that, stay sort of the position of the government's going forward, or do we get it done now and then it becomes another headache, and then next year, next 2 years, next 3 years, so on and so forth. So I think we need to get it done. Again, I think that is definitely a bottleneck for the Canadian economy, especially on the energy side. It would definitely be a big help to all Canadians, not just BC and Alberta. But again, it's something where you just have to let it play out, try and envision how it could go one way or the other way, and set yourself up for, not being surprised by a move either way. We have had the Western Canada Select crude price, so that's the discount we have off WTI, had been at the start of the year out at around negative $30 a barrel, so we were getting $30 less than the WTI price. That's gone back to about a $15 discount, so there has been some relief of the large amount of crude that we had sitting in Alberta. But again, we need to continue to kind of work to alleviate that. And as WTI prices head higher here, it is more important to be able to get that product to market. While prices are good, I think prices could come off a little bit near term, but again, I don't think we're heading back to the lows we have seen in the last couple of years. So having prices be higher, it's sort of like a make hay while the sun shines sort of a story, but we need to get the infrastructure bottlenecks out of the way.
We'll have more with Drew Zimmerman right after this.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, is the rising price of oil also going to bring the loonie up in price?
Well, we definitely saw that today. Today we had a U.S. dollar that was largely flat, and we had a Canadian dollar that was up at one point, almost a full penny. We were at 77 cents yesterday, and we touched 78 cents today. And that was, I would say, almost solely on the back of the increase in crude oil prices. So it is helping the Canadian dollar, and again, when we sort of make new 3-year highs, I think that definitely has an influence. We are known to be a crude exporting country, so that has definitely helped the Canadian dollar. I do watch other influences on the Canadian dollar, like interest rate differentials, for example, that would argue Canada should still be, back towards the lows and even below the recent low of 77 cents. So the differential in crude is definitely bringing out a stronger Canadian dollar. And, if we were on the similar sort of rate path that the Fed is on, and I don't believe we are, I think Canada may raise rates once more this year, and that's it. So that's keeping Canada lower, whereas if we were on a similar rate path, I think these rising crude oil prices would be helping the Canadian dollar even more, and we'd be talking about a Canadian dollar in the 80-cent range to 85-cent range, rather than down at 78 or 77 cents. But again, I think there's more at play in the Canadian dollar, and obviously the jump in the U.S. dollar the last 3 weeks to a month as well have definitely kept a lid on any strength that the Canadian dollar would have had due to the higher crude oil prices.
We've seen the U.S. dollar rise substantially in the past month. Do you think the U.S. greenback is going to continue its climb?
Near term, yes, I definitely think it will. Again, to go back to interest rate differentials, we've got inflation coming in the U.S. tomorrow morning. The headline is expected to come in at 2.5%, the core at 2.2%. So both of those measures over the Fed's sort of 2% midline target. And they have said it is a symmetric target, just like we have here in Canada. So they're going to allow some overshoot. But again, as we start to see those numbers climb to 2.5 and possibly higher, especially with higher energy prices will feed into higher inflation. Then we've got a Fed that I think has a harder decision to make to, say, only raise rates every second meeting. And if they get their feet held to the fire a little bit, then have to raise a little bit faster. I think what we're starting to see again is a diverging central bank policy between the U.S. and other central banks around the world. So the EU or the ECB had been in a period of tightening as well. They cut their bond purchases and were set to possibly announce more coming the end of September, when they may cut the rest of their bond purchases and go right to zero, and or may start to raise interest rates. But we've really seen some of the European data soften over the last several months, or the start to this year, which I think has sort of scaled back the need for immediate action out of the ECB. You've got the Japanese central bank saying, there's no way in hell we're going to slow down our process until we get to our 2% inflation rate. So they are still very firmly leaning on the gas pedal as far as stimulus in Japan. And even to come back to Canada, I think that the need for rate hikes in Canada, while picking up gradually, is again not a need for an immediate rate hike. So I think Canada's going to play the slower game, especially given the high debt level that Poloz likes to keep talking about in Canadian households. So when you look at the fact that the Fed is going to need to continue gradually, or maybe even faster than gradually, and the other central banks are maybe slowing a little bit, it's that real diverging policy that I think can continue to drive the U.S. dollar higher. And already, between U.S. and German interest rates, on 2-year paper, you can get an extra 311 basis points being in the U.S. So if rates continue to move higher here, there's definitely more demand for higher rates on U.S. paper versus anywhere else in the world, especially if you can come over and buy U.S. dollar denominated assets or paper and have the U.S. dollar increase at the same time. It's sort of a win-win if you do it unhedged. So I'm looking for the U.S. dollar, again, to go higher over the medium term. I mean, again, over the short term, we've had a very big run up to 93 on the dollar index. 94.5, I think, is the near-term target that I think we could get to still maybe on this push, maybe consolidate a little bit. But again, I think we can move higher over the medium term, and then over the long term, I think some dynamics will change. But medium term is plenty enough for me to try and get right.
What do you see happening with precious metals if the U.S. dollar continues to rise?
The precious metals have obviously come off in the last couple of weeks with a strong dollar. That makes sense. I also see real rates still being an issue for the precious metals, so that's the nominal rates moving faster or moving higher than inflation is. I think that's got a little bit of a more pain in that trade before it becomes a gain, is how I look at it. So I do think we will start to see the inflation that can overtake the nominal rise in yields, and then that really becomes the wind at the back for the precious metals. But near term, I'm very cautious on gold. I mean, we've tested call it the 1300 level on gold, both at the start of this month and we were at 1304 this morning. I think that 1300 level is vulnerable, especially if we see rates move higher. U.S. 10-year back to 3% today. If we give, the 3% level a full run and break above our last close of 303, then I think, the rates really pressure both the U.S. dollar to go higher and the precious metals to come lower. So, watching the 1300 level on gold, but I do think we're getting close to where we're getting to very good prices for, again, sort of longer term setups for the precious metals. Silver's looking a little bit more ominous. I mean, we were down at 16.10. That $16 level may be more vulnerable in silver, even though we have bounced back more. But again, the $16 level on silver would need to be held to maintain the trend line from the bottom of 2016, whereas gold can drop back to about 1250 before that trend line starts to become a real issue. So I think silver could possibly be a little weaker still near term, but I'm watching gold to say, hey, if we break the 1300, I think we could see it run back down to the 1240, 1250 level. And that would be a critical level. Holding there, I think, could be a good risk-reward opportunity to look for some upside action. Again, if some of those medium-term dynamics have started to shift in where nominal rates are and where inflation rates are headed.
Drew, thank you so much for chatting with us.
Thanks for having me on, Jim.
My guest has been Drew Zimmerman. He's a portfolio manager at PI Financial in Vancouver. His website's pifinancial.com and polarfuturesgroup.com. You're listening to HoweStreet.com radio. Any questions for the show or our guests can be sent to info@HoweStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of Howe Street Media Incorporated.